In 2026, America faces a financial turning point, debt levels rising faster than economic growth, interest costs exploding, and global trust in U.S. stability beginning to shift. This is the debt meltdown moment. For decades, the U.S. borrowed cheaply, but high interest rates have changed everything. Now, Washington pays more on interest than on defense, education, or infrastructure, and the trend is accelerating. What makes 2026 different is speed. Debt isn't just growing, it's compounding. Every new dollar borrowed adds more pressure to interest costs already spiraling out of control. The Congressional Budget Office warns that interest payments may soon become the largest federal expense. When interest dominates everything, governments lose control over their future. Investors are asking a dangerous question: is U.S. debt still risk-free? Once people start questioning the foundation, the entire system shakes, even without a default. A sovereign risk crisis doesn't require default. It begins when the world demands higher yields to compensate for uncertainty. That shift alone can destabilize markets. Foreign buyers, once the backbone of U.S. Treasury demand, are pulling back. Japan, China, and even oil-rich nations are reducing exposure to American debt. Why? Rising geopolitical tensions, domestic instability, and the fear that the dollar could weaken long-term. Diversification is no longer a theory, it's happening. As foreign demand falls, the Federal Reserve becomes the last buyer standing, but printing money to absorb debt has consequences: inflation, currency pressure, and global distrust. The U.S. is now caught between two dangers: raise rates and worsen the debt problem, or cut rates and risk inflation returning. Both paths carry severe consequences. In 2026, interest consumes nearly $1 trillion annually. That's money not spent on defense, healthcare, or innovation. High debt drains national strength. If spending continues at current levels, America could face bond market stress similar to the UK's 2022 crisis, but on a much larger scale with global implications. The debt meltdown is not a sudden collapse. It begins quietly as investors lose confidence, bond yields rise, and refinancing costs become unbearable. Wall Street knows the risk. Hedge funds are increasing positions against long-term treasuries, signaling that insiders expect volatility or a credibility shock. Unlike emerging markets, the U.S. controls the world's reserve currency, but even a superpower can face a sovereign scare if trust erodes quickly enough. 2026 brings a new reality: higher structural deficits, aging demographics, and mandatory spending trapped in programs politicians can't reform without public backlash. America isn't bankrupt, but it's entering a phase where debt becomes the dominant economic force, shaping policy, growth, and even global power competition. China closely watches America's fiscal stress. A weakened dollar enhances Beijing's long-term ambitions. The debt crisis isn't only economic, it's geopolitical. Investors worry most about political paralysis. If Washington cannot agree on long-term fiscal reforms, markets will impose discipline through rising yields. A sovereign risk crisis often starts when markets recognize inaction. When governments delay solutions, investors act first, and consequences escalate rapidly. In 2026, the U.S. faces a mathematical reality: debt grows faster than GDP. No country, no matter how powerful, can escape that imbalance forever. The key danger is compounding. As interest climbs, debt grows even without new spending. America is now paying interest on old interest. Bond traders describe 2026 as the point of inversion, where the government must borrow just to pay previous borrowing costs. That's how crises begin. The Federal Reserve faces pressure from both sides: stabilize markets or control inflation. It cannot solve both at once. If rates fall too fast, inflation may surge again. If rates stay high, the debt spiral worsens. The economy is locked in a delicate balance. Investors fear that political instability will push America into a downgrade. Rating agencies have already issued warnings signaling rising sovereign risk. A downgrade doesn't mean default, but it raises borrowing costs instantly, making the debt problem worse the moment it's announced. The dollar's dominance shields the U.S., but only while global confidence remains strong. If trust weakens, the world could accelerate diversification. BRICS nations are pushing alternatives to the dollar. A fragmented global system could reduce demand for U.S. bonds at the worst possible moment. In 2026, financial markets test the United States. Will it manage its debt responsibly or delay until a full-scale crisis forces action? Some economists argue America can grow out of its debt, but without productivity surges, growth cannot outrun the pace of borrowing. Others propose taxing the wealthy, but even taxing every billionaire at 100% wouldn't cover a single year's deficit. The problem is structural, not superficial. Cutting spending is politically impossible. Any reduction sparks national backlash. America wants services but rejects the cost. A hidden danger is entitlement programs. Social Security and Medicare dominate spending, and both are projected to run deficits for decades. By 2030, mandatory spending plus interest may consume all federal revenue. That scenario signals severe fiscal instability. Investors look at debt to GDP rising, interest costs exploding, and political tensions escalating, and they calculate risk differently. The U.S. can print dollars, but it cannot print trust. Once confidence breaks, recovery becomes difficult and extremely expensive. Central banks worldwide are quietly reducing their treasury holdings. This slow, steady decline is one of the most important signals of the decade. If demand falls too quickly, the U.S. may be forced to offer higher yields, pushing debt into an uncontrollable feedback loop. 2026 is not the year of collapse, it's the year markets start questioning assumptions once considered unshakable. A sovereign crisis begins in whispers: rising yields, declining bids, defensive trading, and sudden volatility in auctions. Bond auctions are a real-time stress test. Weak demand signals fear, strong demand signals stability. 2026 auctions show mixed, unpredictable results. The biggest risk is a buyer's strike, a moment when investors refuse long-term bonds without massive yield premiums. If that happens, the Federal Reserve becomes the buyer of last resort, and that leads straight into money supply expansion. Money printing to cover debt is historically the beginning of inflation cycles. The U.S. is not immune to this pattern. The U.S. can avoid collapse, but only with structural reform, spending control, long-term productivity, and political cooperation. But political polarization makes reform almost impossible. Markets see dysfunction and respond by increasing risk premiums. The debt meltdown is not about numbers, it's about credibility. Once credibility breaks, markets reprice risk instantly. Wall Street now treats debt risk as a genuine variable, not an abstract theory. The tone has changed, and that matters. 2026 could be remembered as the year the world realized the U.S. is not exempt from fiscal limits. Even superpowers face mathematics. The IMF warns that rising U.S. debt could destabilize global markets. A crisis in America would not stay in America, it spreads worldwide. If confidence falls, Treasury markets could see extreme volatility, forcing emergency interventions and liquidity injections. This is how sovereign scares happen, not through default, but through fear that grows faster than reassurance. The U.S. must choose between stability or political comfort. Every delay increases the future cost of action. Investors understand one thing clearly: once debt crosses a threshold, markets, not governments, set the rules. Some predict mild turbulence, others warn of a generational debt crisis. The truth depends on how Washington responds. A soft landing requires discipline, controlled spending, measured taxation, and credible long-term plans. None exist yet. A hard landing triggers market stress, inflation waves, and political conflict. It's the scenario investors quietly prepare for. The worst-case scenario is a full confidence shock, rapid yield spikes, currency weakness, and forced fiscal tightening. But even in crisis, America retains strengths: innovation, global alliances, and the world's deepest capital markets. The future depends on whether the U.S. uses these advantages wisely or wastes them through political gridlock. In 2026, debt becomes the central theme of American economics. Everything, from markets to elections, revolves around it. The question is not whether debt matters, it's whether America will act before markets force action. History shows that nations rarely fix debt problems voluntarily. They wait until pressure becomes unavoidable. Investors watch deficits, interest payments, and political rhetoric. None currently signal long-term discipline. But crises also create opportunity. Those who understand the debt cycle can anticipate market shifts earlier than others. The debt meltdown is not destiny, it's a warning. America can still change course if leaders choose stability over division.
The next decade will define whether the U.S. remains the world's financial anchor or becomes its greatest vulnerability. Debt doesn't break countries instantly. It erodes confidence slowly until the moment everything changes at once. In the end, the world watches one question: will America confront its debt crisis or let the 2026 meltdown reshape the global order?